If you're 42 and feel like you've missed the boat on investing, you haven't. Starting now gives you the wisdom to ignore the noise. For years, I watched people get tangled in complicated strategies, chase crypto, and then do nothing, scared of making a mistake. I did the opposite. I built a simple, powerful portfolio for aggressive growth without unnecessary risk. Today, I'm showing you my exact strategy and asset allocation. That feeling of being behind? It's just a feeling. Your journey to financial strength starts now. Number 1, your superpower is simplicity. When you're starting in your 40s, your biggest enemy is complexity. It's the voice whispering you need a secret stock tip or 25 different funds to catch up. But market data proves simplicity wins. The more complex your strategy, the more decisions you make, and the higher the odds of an emotional, expensive mistake like panic selling in a dip. A simple, automated strategy is your best defense. It puts wealth building on autopilot so consistency and time do the work. This isn't about finding the next hot stock. It's about owning the entire market. Your asset allocation, how you split your money, is responsible for over 90% of your long-term results, not stock picking. We're going to get that one big thing right and tune out the rest. The goal is to be a disciplined investor, and that's a game you can win starting at 42.
Number 2, reframing your time horizon. Let's tackle the biggest mental block, the idea that you don't have enough time. This is wrong. At 42, you're not investing for 15 years. You're investing for the next 25, 30, maybe even 40 years. If you retire at 67, that's a 25-year runway. But you'll likely live into your 80s or 90s, meaning your portfolio has to support you for decades after you stop working. Your time horizon isn't until retirement, it's through retirement. This long runway changes everything. It means you still have time to be aggressive. Market crashes are terrifying, but with decades to recover, they're blips on a chart. For the first 10 to 15 years, a downturn is a gift. It lets you buy more of your investments at a discount, turbocharging future growth. Stop thinking, I'm 42 with only 20 years left. Start thinking, I'm 42 with a 30-plus year investment journey ahead. Number 3, the 80-20 power portfolio, my exact allocation. This is the core of the strategy, a simple 80-20 portfolio. It's 80% stocks for growth and 20% bonds for stability. No commodities, no crypto, no individual stocks. The 80% growth engine, total world stocks. This is the engine that drives your wealth. We're not picking stocks. We're buying the entire haystack with one fund, a Total World Stock Market Index Fund ETF. This makes you a part owner in thousands of companies, large, medium, and small, all across the globe. You get the US market, Europe, Japan, and emerging markets. This provides incredible diversification. If one company or country has a bad year, thousands of others are there to pick up the slack. For this, look for low-cost ETFs like the Vanguard Total World Stock ETF, VT. The 20% defensive shield, Total Bond Market. If stocks are your offense, bonds are your defense. Bonds tend to have an inverse relationship with stocks. When the stock market crashes, investors often run to the safety of bonds, which helps their value hold steady or even go up. This smooths out the ride psychologically and gives you dry powder to rebalance by buying more stocks when they're on sale. Just like with stocks, I use one fund, a Total World Stock Market ETF, like the Vanguard Total World Stock Market ETF, BND. This part isn't for home runs, it's your portfolio's shock absorber. Number 4, how to implement this strategy in 3 simple steps. Knowing the strategy is great, but action is what counts. Here's how to do it. Step 1, choose the right account. The account you choose matters because of taxes. Follow this order. 401k with employer match. If your job offers a match, start here, no exceptions. Contribute enough to get 100% of that match. It's free money. Next is a Roth IRA.
Your money grows and is withdrawn in retirement completely tax-free. Be aware of income limits. For 2024, to contribute the full amount, your income needs to be under $153,000 if you're single or $242,000 if you're married filing jointly. Taxable brokerage account. Once you've maxed your IRA and are contributing to your 401k, use a regular brokerage account for anything extra. Step 2. Buy the two funds. Inside your account, search for and buy a Total World Stock Market ETF and a Total Bond Market ETF from a low-cost provider like Vanguard, Fidelity, or Schwab. Split your money 80-20. If you invest $1,000, that's $800 in the stock fund and $200 in the bond fund. Step 3. Automate everything. This is the secret weapon. Set up automatic transfers from your bank to your investment account every payday. Then, set up automatic investments to buy your two funds in that 80-20 split. This is called dollar cost averaging. You invest consistently, whether the market is up or down, which removes emotion and guarantees you build wealth over time. Set it and forget it. Number 5. The two numbers you must track. Once you're on autopilot, track just two numbers. Number 1, your savings rate. When starting at 42, your savings rate is more important than your rate of return for the first several years. You have to be aggressive. Aim for 20% to 25% of your pre-tax income. This might mean reviewing your budget or boosting your income. Every extra dollar you invest now is incredibly powerful. Number 2, your annual rebalance. Once a year, and only once a year, do a quick tune-up. Your 80-20 split will naturally drift. After a good year, you might be at 85% stocks and 15% bonds. Rebalancing means selling a bit of what did well, stocks, and buying what didn't, bonds, to get back to your 80-20 target. This forces you to sell high and buy low, managing risk and keeping your portfolio on track. At 42, complexity is your enemy. The noise from financial news will paralyze you. Your greatest strength is choosing a simple, proven path and sticking with it. Let's boil it down. 1. You have a long 25-plus year time horizon. 2. Adopt a simple 80-20 portfolio, 80% total world stocks, 20% total bonds. 3. Automate everything in tax-advantaged accounts. 4. Get obsessive about your savings rate and rebalance once a year. There's an old saying, the best time to plant a tree was 20 years ago. The second best time is now. You can't change the past, but you control today. Starting at 42 isn't a handicap, it's your starting line. You have the plan. Go execute.